Hello and welcome to Macro Matters, the economics and politics podcast from Aberdeen Standard Investments. My name is Paul Diggle, and along with my co-host Stephanie Kelly, we're guiding you through the macroeconomic and political themes that are driving global markets. And today we're asking the question, how is this recovery different? Just as the global recession created by the COVID shock was highly unusual, the recovery out of the crisis is also going to be atypical in all sorts of ways. It's incredibly rapid, yet it could leave a legacy of long-term scarring. It's going to be services rather than manufacturing-led, and it's spearheaded by developed markets rather than emerging markets, all unusual features of a business cycle recovery. So joining me to discuss how this recovery is different are Jeremy Lawson, our chief economist, and Luke Bartholomew and Robert Gilhooly, two of our senior economists. Luke, let's start with you. So you were hosting the podcast last week, but you're back in the guest seat today. A year ago, the two of us co-authored a paper called How is this recession different? But fast forward 12 months and we're hopefully in the recovery phase. Some of the features of the unusual nature of the recession that we identified 12 months ago were its length, its short length, its incredible depth, and the speed at which that contraction happened, and also its synchronicity across countries. How is the recovery phase playing out in terms of those variables, length and depth and synchronicity?
Yeah, I think the first thing to say is that it's no longer synchronous, right? One of the distinguishing features of this recovery is quite how divergent it is. EM-DM divergence within the developed market complex as well. There are quite significant divergences. And obviously that reflects progress in terms of keeping the virus under control, progress in terms of vaccine rollout, and then sort of policy as well. So yeah, the first thing to say is that different economies recovering at different speeds. And I think for some of those economies, it is pretty much a mirror image of what went before. So a very sharp downturn, very short downturn is being followed up with a very, very quick recovery over a quite short period of time. And I have the likes of the US and China in mind for that. Again, sort of reflecting both vaccine policy and economic support as well. And I suppose, the size of the US and China is such that by the time those two have had a pretty sharp recovery, actually at the global level, things start to look that way as well. But that does disguise that, there are a number of countries that are experiencing a much slower recovery, or indeed double dips, triple dips potentially, as lockdown measures have come and gone again, policies being more or less supportive. And so for those countries, they could end up tracing out a profile of GDP that looks much more like the recovery from the global financial crisis and from 2008 onwards, and that is a sluggish recovery, struggling to get both real output and nominal activity, so inflation as well, anything like back to the trend levels that it's seen before the GFC.
And that sort of slow recovery was certainly very, very characteristic of the financial crisis. Thinking back to previous and more typical business cycle recessions, I think what we observe is you do get some lasting legacy, some hit to the long-term growth path, but certainly nothing like on the scale of the financial crisis. And the fact that lasting hit will actually be quite divergent across economies, I think that's an important feature of the recovery, as you say there, Luke. But what about policy support then? So the recession was met with enormous policy support, and that has, of course, boosted the recovery, at least in a subset of economies like the US that you identified. Is the scale of policy support during this recovery atypical or unusual? And should that give us sort of different expectations for the recovery phase than we might ordinarily have?
So I think if you just look at the brute numbers of the thing, how much interest rates were cut, how big central bank balance sheets got, how large government deficits got, the kind of policies that were being experimented with. All of that seems to be extraordinarily large. But I think it would be something of a mistake to sort of compare policy responses just in sort of the brute aggregate numbers. The right way to think about the scaling of policy is, well, how big is the shock that the policy is responding to? So, going back again to the GFC, the financial crisis, again, on sort of brute aggregate numbers, that looked like an extraordinarily large policy response in terms of how big government deficits got, in terms of cutting interest rates down to the effective lower bound. This was the first time for many developed economies that happened. How big central bank balance sheets got. Again, it was the first time for many developed economies that central banks started expanding balance sheets in that way. And so on that level, it looks like extraordinary policy. And yet, I think our analysis of policy following the financial crisis, that it was too small, that there was insufficient policy response to deal with the size of the shock. And that's one reason that many countries experience such a sluggish recovery. So even though it looked large on the brute numbers, it was actually too small. And so similarly with the COVID shock, I think the right way to think about it is not that these numbers are extremely big. It's the fact that the COVID crisis was extremely large, and therefore that called out for a very big policy response. And it's quite plausible still that it'll turn out for some economies that the policy response will have been too small. I think that's a lot less likely in the US. And as we sort of touched on previous podcasts before, there is an argument that if anything, the policy response has been too big out there. It's not a concern that we're especially worried about, but it is, that is, I think, the distribution of risk, that it's skewed towards policy being too big rather than being too small. And I suppose I would say that is a nice problem to have. But for other countries, it's just too early to tell whether the support will have been sufficiently scaled, and whether we might still see support being withdrawn earlier than we think is appropriate, and therefore a more sluggish recovery than otherwise could have been achieved.
Yeah, we've talked before on the podcast, of course, about the scale of US stimulus, but also about prospects for, say, European fiscal policy, which at the moment is pretty stimulative. We have hopes that it will remain stimulative, and indeed the architecture of the European fiscal rules will be reformed to help fiscal policy remain more reactive. But of course, there are risks in the other direction as well, that some economies like the Eurozone, even perhaps the UK, repeat some of those past mistakes of withdrawing stimulus too soon. Great. So Jeremy, building on what Luke has said, a highly unusual feature of the COVID recession was that it wasn't really a typical end cycle event. It wasn't caused by an overheating economy, a breakout in inflation, a central bank tightening cycle in the way that many business cycles end. Instead, it was more like a completely exogenous shock. And that raises an interesting question, which is, in this recovery phase, are we now recovering into a completely new business cycle that we can expect to stretch on for many years ahead of us? Or are we back into the old, mature expansion phase that we're in pre-COVID? So this is the question of how long the sort of business cycle is going to last from here. What are your thoughts on this question?
I think it's somewhere between the two. So let me explain with the example of the US labor market. So the US employment to population ratio for prime age workers is right now still about 3.5 percentage points lower than it got to at the pre-COVID localized peak, right? And so we're around 15 months into this shock now. And so there has been a substantial cyclical knock to the US labor market. And the same is true for Europe, although it's a bit milder because of the nature of the short hours sort of working schemes. But the point is that the labour market has been knocked off its pre-COVID equilibrium. So from that standpoint, I don't think we can just sort of say, okay, we're resetting at this point, and now it's as though it's just a continuation of the pre-COVID business cycle. I don't think that would be true. However, if you compare that labour market shock with the shock associated with the global financial crisis, and in Europe's case, the twin recession associated with the sovereign debt crisis and the policy mistakes that were made around that, it does look radically different from that standpoint, right? So the level of the US unemployment rate today is back to where it was in early 2015. In Europe's case, the unemployment rate sort of today sort of stands where it did in early 2000 and in 2018. So I think it's absolutely fair to say that the shock to the labour market has been much less severe. And so therefore, if you were to compare spare capacity at the 15-month stage of the recovery after the financial crisis with now, the labour market is in much better condition. So assuming that you get a significant recovery, and I think it's reasonable to expect a more rapid recovery than we saw after the financial crisis as well. There's certainly, as you said and alluded to, fewer headwinds associated with this recovery likely than after the financial crisis, fewer imbalances that had to be resolved, then we'll likely get back to full employment sort of more quickly. And then depending on how policymakers sort of manage that sort of more rapid sort of return to full employment, and certainly what the underlying inflation consequences turn out to be, I don't think it's unreasonable to conclude that this business cycle may turn out to be shorter.
What about the status of other typical imbalances that you have at the end of a normal business cycle? So things like excesses in the housing market or in bank lending. Are these... Did those unwind during this shock, or are they still at levels that we might worry about in a typical sort of late cycle period?
Yeah, again, it's interesting because I think we argued before the crisis that those imbalances were not that great to begin with, right? So if you look, for example, at household balance sheets at the end of 2019 across most advanced economies, certainly the more systemic ones, less true of some of the peripheral countries like Australia, New Zealand, Sweden, Canada. But those household and corporate balance sheets, they certainly weren't as weak as was the case in 2006, 2007, and 2008. And even if you sort of look at emerging markets, we were looking at an environment where we would have argued that there were pockets of imbalances rather than major systemic imbalances. So I think from that perspective, it is not like we then sort of emerged into a period where now we look at the balance sheet and say, wow, this looks sort of really unsustainable. This must unwind in some way. What I think is true, though, is that this has been a leveraging event. If you look at the ratio globally of non-financial corporate debt to GDP, the ratio of household debt to global GDP, and the ratio of public debt to GDP globally, they've all increased, right? So we're not starting this cycle from a position of low leverage. Now, this can play out in a couple of ways. It could just sort of simply constrain growth through this recovery in some way, so it becomes an inhibitor to demand. Or equally, it might also be the case that given the nature of the policy sort of environment, maybe sort of new imbalances turn out to be generated, and that itself may represent a threat to the cycle later on. Don't get me wrong, I don't think we're there at the moment, but that is plausible that we get there. And if that occurs, then that will not only sort of condition our view of recession risks at some point, but also the nature of the vulnerabilities when they unwind.
And one of those sort of new imbalances that we've thought a little bit about is the potential for zombie companies, so companies kept alive during the pandemic by the amount of government support, which then could be sort of one of these post-crisis imbalances that emerge. But some good reasons there to think that we're not straight back into a very late cycle regime and an imminent business cycle recession. But I think some good reasons to think that it's also not going to be another 10, 15-year expansion phase like the one we lived through previously. But let's move then to another unusual feature of the recovery, which is the split between manufacturing and services. The typical recovery is often manufacturing-led. Global goods demand is highly cyclical, and manufacturing production can sort of come back online after a downturn very rapidly. And by contrast, the services sector is often thought of as less cyclical. How is that dynamic potentially going to be different during this recovery phase?
Yeah, so it's worth saying that in a sense, the global economy has been recovering for a year now in sort of fits and starts. And so actually that cyclicality of the industrial sector is sort of present in the data over the past 12 months. So what we're now going to talk about is what it looks like, the recovery looks like from here. But sort of again, I've got sort of a numerical example just to make this sort of very clear for the listeners. So if you look at the profile of US real goods consumption and real services consumption during the previous US recession, so this is the 2008-2009 recession, so peak to trough, real goods consumption in the US declined by about 8% during that recession. And real services consumption barely dropped. So at the most by a percentage point. In fact, it was probably a little bit less than that. Right. So you have a period where service consumption flattened off during that recession, but it never really declined. So this recession has just been radically different, right? So both goods and services consumption dropped initially, but then goods consumption recovered incredibly rapidly, so that in the US and many other countries, goods consumption is now currently running well above its pre-COVID trend. And whilst global industrial production hasn't recovered as quickly as that, in part because of supply bottlenecks, it's certainly recovered sort of much more quickly than services production has. So what you were really doing here right now is we're looking at an environment where the goods consumption share globally has risen very substantially, where there's much more spare capacity in the global services sector than in the global goods sector. And given the nature of the reopenings that we're expecting, assuming that our sort of projections for vaccination and a reduction in the intensity of the pandemic turn out to be true, then there's just simply much more room for expansion in the global services sector. So something that we're used to thinking of as acyclical becomes hyper-cyclical on a 12 to 1 to 18 month horizon and is likely to drive the recovery from here. And I think that's important, not just from an economic standpoint, but it's also important from a market standpoint. Because when analysts sort of think about cyclicality in markets and the type of firms that typically do really well in expansion, in some ways that cyclicality in the industrial manufacturing goods consumption side is already in the past. It's not to say it's going to substantially look worse over the next sort of few months, but that speed of recovery is going to moderate. And so then most of the growth is going to rotate into services. And so that might mean that the pattern of equity, of profits in the corporate sector, and then ultimately the pattern of returns is also different from what we'd sort of see in a typical recovery as well. So it just marks it out, like just what we said beforehand, that this is just an extremely unusual cycle compared to previous ones.
Great, and that's sort of, as you say, changing what we call a cyclical stock to some extent.
Yes.
So Bob, turning to you. The final way in which this recovery is different, or the way in which we want to talk about the recovery being different, is the EM-DM divergence that's opening up. The classic recovery is often EM led. At least that was certainly the case coming out of the financial crisis, when China was the sort of rising tide that lifted all boats of the global economy because of its very large credit stimulus. This time around, it's different. It's more of a DM-led recovery, and there are a number of reasons why the EM recovery, at least in a relative sense, is lagging behind. So let's get into those. One is China itself. Why is China not providing the huge lift to the global economy that it did coming out of the financial crisis?
Yeah, thanks, Paul. I guess there's kind of a couple of reasons kind of spring to mind. First of all, China had a very kind of sharp and kind of short shock, bouncing back pretty quickly. So in that sense, it used policy stimulus in that initial stage, but now that it's basically kind of almost back to trend growth, very much getting close to fully recovered, that need to kind of keep on providing stimulus that would be supportive for other EMs just kind of isn't there. And then I think probably the other point might be a kind of careful what you wish for scenario. After the global financial crisis and also after the kind of the sort of industrial slowdown that we saw around 2015-16, China threw quite a lot of stimulus at the domestic economy that spilled over internationally. But around that time, China was getting an earful from the IMF, other international organizations saying, look how risky these sort of credit bubble, credit fuel growth is. You really need to kind of get your financial stability house in order. And, I really think, it's been quite remarkable actually that through this kind of COVID shock, the PBOC and other state bodies have really kind of held the line on financial de-risking. That's another reason why we're kind of not kind of seeing a repeat of the global financial crisis or that 2015-16 period that I mentioned.
And of course, the goods and services dynamic that Jeremy was talking about has implications for the relative strength of the the Chinese recovery and the EM recovery as well, right?
Yeah, that's right. As Jeremy took you through there, the kind of composition of growth this time round will be very different for EM. So, like normally when we get that kind of US policy or even a kind of just general DM pickup in growth, that would be, I think, unambiguously good for emerging markets. But this time round, we might be talking about more of a situation where kind of US fiscal policy is really kind of be stopping goods consumption in the US from falling. So we might not see it rise either. Combined with kind of normalization in the kind of share of consumption between goods and services and other developed markets, I think this really means we may well see, we just won't see that kind of normal boost from kind of rising GDP in developed markets through to trade and industrial production that, is so important typically for an EM kind of led recovery.
Great. And then virus and vaccine dynamics are, of course, key to this divergence as well. DMs have been able to secure very large pre-orders, now very large deliveries of vaccines to cover their populations, and many of them are now seeing the pandemic itself seemingly, hopefully, in abeyance. That's not the case, of course, in some high-profile EMs like India, which are still having very bad viral experiences. What's the point at which you would expect the EM pandemic to be drawing to a close? Is this just operating in a lag relative to DMs, or are they going to be in this shock for a long time more?
Yeah, no, it's definitely one of the kind of key reasons why EMs are facing this kind of longer duration shock and making it harder to kind of catch up with DMs. I think the thing is, it's looking increasingly divergent across the EM landscape. We quite often talk about EMs as one kind of single aggregate. And while I think it is true that on aggregate, if you have average through, vaccination is lagging behind, that does miss, I think, some quite kind of important differences. We've seen a very marked acceleration actually in Chinese vaccinations recently. We've got some high income emerging markets such as Chile and Israel. Some even actually the Eastern European countries have also seen a very marked acceleration in vaccinations over the last few months. So, this kind of somewhat disparate group of countries, may be operating as something close to a DM timetable in terms of vaccinations, whereas we see kind of many other kind of regions and countries really lagging quite far behind. LATAM is kind of starting to catch up from a kind of low base. We still think herd immunity might be something more like a kind of middle of 2022 story for much of LATAM. And APAC, where actually, they've come through the shock relatively well, due to their ability to manage the virus really well. But I think that's also taken away some of the urgency to actually get the vaccines in people's arms, combined with maybe some difficulties in actually obtaining supplies. We really are seeing much of Asia really lagging behind on the vaccination front. I think we've seen a few kind of, shall we say, chinks in the armor recently within Asia. Malaysian case numbers have been continuing to rise, are looking quite concerning, getting up to the sort of kind of daily case numbers that we're sort of seeing in some countries in LATAM, to give you a bit of a kind of metric there. Still at very low levels. But we have seen rises in Thailand and Vietnam, and even some very small rises in Taiwan as well. And, there is more evidence, I think, that the Indian variant itself has spread to other countries within Asia. And, given the tragic experience we've seen in India, is definitely one to watch to whether I guess the kind of ability to manage COVID well in Asia continues going forward.
Yeah, it seems like part of the slowness of vaccine rollout in Asia is itself a legacy of previous successes in containing the virus itself, and perhaps that lent a bit less urgency to vaccine rollout there, and why, by contrast, some of the rich DMs that did so poorly in the initial waves were amongst the fastest in vaccine rollout as well. So then the final dynamic is what's going on with monetary and fiscal policy. So a lot of DMs are still running extremely supportive monetary and fiscal stances. The US patently so when it comes to fiscal policy, but I think European fiscal policy is going to remain fairly supportive for a little while yet as well. And although the Fed in the US is talking about tapering asset purchases, for now monetary policy settings I think are very accommodative and supportive. Why is that increasingly less the case in EM? So why are some EM governments turning towards more austere fiscal policies, and why is there sort of the beginning of a rate hiking cycle amongst some emerging market central banks?
Yeah, I mean, some of it, of course, goes back to what we were discussing before. While US fiscal policy is kind of good, obviously for boosting the economy, for EMs, of course, that's of course also tightening financial conditions, and combined with this kind of lagged effect, this rotation in the composition of demand away from goods, that's probably tightening financial conditions a bit more in emerging markets than it would have done otherwise. We've also had very strong commodity price rises combined with kind of base effects on inflation coming off. It's that sort of combination of kind of higher US yields, rising kind of headline inflation has just really made the kind of policy challenge for emerging market central banks much more difficult, much harder to kind of look through those pressures. I think that's definitely been kind of part of the reason why we've seen a kind of less supportive stance from emerging markets. But I don't think that's the full story as well. I think to the extent that we can disentangle it, I think we'd say probably the domestic backdrop has become much less supportive. In many countries, we're just not really seeing policy flex with the viral trends. India is a very good example there, where the additional fiscal spending is coming through despite this massive second wave, and clearly a tragic cost in human life as well, has been very, very minimal. And this is really, I think, for many countries, quite a stark contrast. 2020 policy in EM was relatively unconstrained. I think in many ways it's kind of a slightly lighter, maybe a slightly smaller version of DM policy. But now we're moving into a much more kind of constrained world. I do think there's maybe been a little bit of a failure by policymakers to make fiscal in particular, but also monetary policy a bit more kind of state contingent in 2021. For many countries, particularly where we're still seeing quite good trade balances and also depressed private sector, it's kind of not clear that fiscal policy couldn't have done more. So I think some of this reflects kind of fears about spooking the markets, a rising risk premium, but also just kind of the domestic political situation as well. So, I think as a region, LATAM really stands out here, where we've clearly seen, continued very high case numbers, but fiscal policy has very much been in kind of retrenchment mode. In contrast, I'd probably say that fiscal policy in Asia has been kind of more neutral, more supportive with respect, excluding in India, as I just mentioned earlier.
Brilliant. Well, Luke, Jeremy, Bob, thank you very much for stepping us through why this recovery is different. That's about all we have time for this week on the podcast. Thank you for listening. Remember that we have a mailbox, macromatters@aberdeenstandard.com, if you'd like to get in touch. Don't forget to like or subscribe on your podcast platform. But until next time, goodbye and good luck out there.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.